All right. Happy Friday, everyone. My name's Kyle Ranke. I'm the Chief Operating Officer of the David Green team. Hope everyone's doing well. David is on his way. He'll be here soon. So don't worry. Don't freak out. Don't get scared. He'll be here soon. But I hope everybody is doing well on this Friday. It's a magical Friday. Yes, that's right. It's March 17th. You know what day that is. St. Patty's Day, St. Patrick's Day. As we get this thing started, I'm kind of curious. Let me know in the comments who's here, who's hanging out tonight. Where are you from? We got flipping reality home, reality homes, reality home. Hanging out from Houston to Texas. Welcome. Rosalie, great to see you. Representing all the way from Staten Island, New York. And yeah, happy St. Patty's Day to you too. We got LNA Imbert saying excited for your first BPCon 2023. Yeah, I think it's in Orlando this year. I got to get my spot reserved. I haven't done that yet, so we will see. We got Kenley representing from Florida. Welcome. Hope you're doing great. We got Angela Haydorn, Spartan League member. I got my new Spartan League gear here. Super excited. I also got a new little microphone cover thing. So yeah, what's up, Angela? Jason also from Maryland and in the Spartan League as well. What's going on? Happy St. Patty's Day to you as well. Marlene, what's going on? Representing all the way from Miami. Great to have you here. Oh, Mikhail, look at all of our Spartan League members showing up tonight. They're the most vocal, the most courageous people we all know. Hanging out from California. That's right. We know how to party. We keep it rocking. Great to see you. Lisa, also from the Spartan League. Look at all these Spartan League members. If you don't know what I'm talking about, there's this thing called the Spartan League. You go to SpartanLeague.com. That's a private mastermind for the David Green team. And you can see they're all hanging out here tonight to represent the family and represent the things that they have learned. And I'm telling you, these are some of probably the smartest people that I know. But yeah, it's SpartanLeague.com. It's a private mastermind that David and myself run, and really it's run by all of these amazing people in the mastermind. Yes, I love it. Mikhail says Spartan League in the house. They are here representing Florida Realtor. Great. Love it. Who else we got? Dora, the Explorer from Napa. Once again, good to see you. Thanks for hanging out. Chris Figueroa, always showing up consistently. Another Spartan League amazing person from Lowell, Massachusetts. Hopefully I said that correct. I'm not quite sure. Just a reminder, David will be here shortly. We're just getting this thing kicked off. He's finishing up a meeting, probably finishing up lifting weights. He'll probably bring his food, be eating it in front of all you guys. We're in for a really good talk tonight. And looking forward to it. This is actually some really good stuff that we're going to talk about specifically around Silicon Valley Bank and what's been happening with that. If you've been living under a rock, there's been a lot of bank crises happening, not just with SVB, with other banks too. And there's a little bit of fear. There's a little bit of timidity in the air and in the economy, and a lot of people kind of worried about it. So we're going to talk about what that means for you, what that means for me, what that means for us as real estate investors, entrepreneurs, real estate agents, people looking to build their businesses, people looking just to get started. We're going to talk about what that means for everybody. SACH, Sach, what's going on, Sach, from North New Jersey. I'm loving it. Happy St. Patrick's Day to you. And then we got Scott Crawford representing, showing the really good profile picture there, looking very, very dapper, very professional from Denver. Great to see you. Hopefully it's not snowing too much, too crazy. Mario representing from Miami. Sarah, Minneapolis, Minnesota. Don't you know? Good to have you. Donald Hinton, what's the biggest mistake you made? Probably just using that Minnesota accent was probably the biggest mistake I've made, at least today. Hanu Aloha, what is going on? Aloha from Hawaii. I'm feeling like I need a little Hawaii in my life right now. That'd be really nice. Gorgeous weather there on the islands. I heard you guys got a lot of rain, though, the last several weeks. So glad to hear that you got the good weather now. Let's see what else we got. March Madness might get you pulled away, but you're here from now, Zach. Well, Zach, you gotta have the dual. Man, you gotta do what I do. You gotta have the dual monitors set up here. Maybe you're watching on your phone. I don't know, but you gotta have the game on mute on one device. That's what I do. I put it on my laptop. I put it on mute, and then I also will have whatever we're doing here on the main screen, on the big one. So don't tell David. This is actually a secret. I do this in some of our Zoom meetings at the DGT. No, I don't. But I do sometimes at when we have like our mastermind or different talks going on. I'll just have like the NBA games on mute, and I'll just kind of watch and just be watching the score. That's what dual screens are for. They're for multitasking. They're for being smart. They're for doing two things at once, and that might include watching a little March Madness. Nadia, once again, hanging out, representing from Tracy, California. Good to have you. Let's see here. Who else do we got? Oh, thank you, Sarah. She says, I thought it was pretty good. I'm assuming she's talking about my accent. Yeah, I felt a little vulnerable when I did it, but I did it. Art, representing from, not telling us where. He just says hello. Good to see you. Yeah, you did have a lot of rain. It was so cold, too. Yeah. What was it, like 72 was cold for you guys, probably, I'd imagine. Danielle, what's going on? Great to have you. Javier, another Spartan League member showing up. I love this. I love to get all of the Spartan League representation here. Let's see. Who else do we have coming? Oh, Ken, and I'm not even going to attempt to pronounce your last name, but it looks like a good name. Hanging out from Tampa. Great to see you. And then, by the way, David, let me show you what I got to bring to you. Can you hear me, David? Check this out.
Oh, how cool is that?
It just came today, man.
Sorry, on Instagram, you guys can't see what Kyle's showing me. It's the new mic cover for Spartan League. Let me show you something, Kyle.
What we got?
This also came today.
Ooh.
This is a Spartan holding
the pen.
Spartan League pen.
Is the pen supposed to go on his hands like that? His arms?
Yeah, it's like he's making an offering. He's like his sword.
Yeah, that is awesome.
It's on my desk.
Oh man, I'm telling you, Spartan League is where it at. We have about like 10 Spartan Leaguers here tonight, hanging out with us, along with Brian from Central Michigan, Tom from Central Pennsylvania, and let's see what Jason says. He says, they're financial Spartans because this is how they're spending their Friday nights. Very
Amen.
Well.
That's right. Everybody else is out there losing money Friday, and our followers are here learning how to make it and save it.
That's right. That's what we do. That is what we
Let me just run something by you guys that hate saving money, okay? Because every once in a while we come across those people. I love you. We have love for you. I understand not everybody's a saver, but you need to be. And here's why. If you would rather go out and make $100, that's more like making $70 because you're going to get taxed on that money, okay? So you spend time, which you've lost, to make money, which you then get taken from you, and then you're probably going to go spend that 70, all right? When you save $100, it's better than making $100, okay? You actually have to make like $140 to equal the equivalent of saving 100. You also get your time back. Right. So as we track what we're spending our money on, what we're finding is that there was a lot of things that we were spending money on that were not providing satisfaction. They weren't making us happy. They're not actually helping us achieve our goals, which is what we're going to be talking about in Scottsdale at the goal setting retreat, which Kyle had a great idea. I think we're going to go live on Friday night from there. But what I'm getting at is when you stop spending money on things, you still need dopamine. You still need to be happy. You still need some form of fulfillment. So what happens is you start having better conversations with friends. You start deepening relationships. You spend more time with your kids. You spend better time with your kids. You don't just spend time with them. You impart lessons into them. And then as your kids start to feel more like you start to like them more, which makes the time that you spend with them even better. Same can be said of your spouse. Same can be said of your friends. Like if we're not spending money, Kyle and I are going to spend more time having deeper conversations on the phone. It's going to make our friendship better, which means when we spend time together, it's even better. Money robs you of all that. spending money robs you of all that. Okay. It's not just the time that you put into making money that hurts you. It's also what it takes away from you. And we didn't realize any of that stuff until we started tracking where our money was going. And then the other thing we track is fitness, because, you know, there's more to life than just financial fitness. There's physical fitness too. And as you guys can see, Kyle is turning into a beast. So if you guys want to become a beast, oh, you got the quick flip hoodie on too. Can you show us how that works?
Oh yeah, I can do a little demonstration. I gotta step back here. So
guys, we're gonna be giving these away as a way to draw interest in Spartan League. This is super cool. Check out what this hoodie does. Okay, he takes it off. We see his stunning physique.
I know. I'm getting laughed at.
No one is laughing at you. They're jealous of you.
They're loving me. You flip it inside out. Like so.
So you take off your hoodie, instead of tying it around your waist, you just turn it into this bag that you can put all your gear in, and then you can put it on your back like a backpack. Can you actually get it so you can show the logo? I think you put it upside down.
Darn it.
Yeah, it's all right. He was trying to do it quickly because I was putting pressure on him. You can tell from my tone.
There's a reason they call it quick flip.
Right? Now you got a cool Spartan League logo on the back where you keep all your gear, and then you get cold, you just unflip it and put it right back on again. So
boom.
I want to join the Spartan League just for the hoodie. That's funny, says Ken. Thank you. These are custom made. You can't get them anywhere else but from us.
Yep.
And so you guys have heard us kind of mentioning this from time to time. Well, we're getting very close to where Spartan League is going to be real. If you guys like those Grunt League t-shirts that I wear sometimes, we're having those custom made with the Spartan League logo. So if you're a cop, first responder, military, you know about Grunt League. It's some of the best fitting clothes out there. It's the ones I wear on the pod because they have like the little American flag on one side. They're freaking cool. We're getting those made as well. So we're not going to talk about this forever, but I am super excited. Like Marnie says, I need all the swag. The swag's been coming in, and I've just been unpacking it and looking at it. And there's water bottles, there's coffee mugs, there's cool figurines, there's shot glasses, there's bottle openers, there's stickers, there's pop sockets to put on the back of your phone. We have an entire swag package that when you join, you're going to get all that stuff we mentioned sent to you, as well as everything else. So Kyle and I are pretty excited about that.
I am stoked about it, and I'm stoked about all the people that are here tonight. I'm feeling a lot of really good energy tonight, especially with the topic that we have. A lot of people, and I'm really curious from the people here. Type in the comments, what are your thoughts, feelings, concerns about the banking industry right now, specifically with the supposed crisis that's happening, what people being concerned about what's happening with the shutdowns of banks. Are we in another too big to fail sort of situation? So let us know what you think. But I'm kind of curious, David, what is some of the things you've been hearing just from an overall standpoint before we jump into these videos?
Oh boy. I mean, if you're into finance, if you're into economics, it's getting spicy. It's getting interesting. It's also getting a little scary. If you don't like change, if you don't like disruption, you probably don't feel very good. Okay. So I'm going to make my biggest effort. Kyle will too, to be respectful of all the different types of personalities. There's a lot of people losing money, not just banks. Okay. Let me just say this. I'm in several other wealth building groups, stuff like GoBundance. I know a lot of people that own a lot of real estate, right? I know some of the guys that rub elbows with Robert Kiyosaki. I know some guys with net worths well over $100 million. I'm privileged enough that me, Brandon Turner, we meet a lot of these kind of people. The guys making money in real estate right now are the ones wholesaling properties to investors that are losing money, or running educational programs where they're charging $5, $10, $15, $20, $25,000, sometimes $100,000. They're the ones, they're not making money from the real estate. They're making money from their educational programs. Now, when you're making 500 grand a month, you can go pay cash for a property that's not going to bleed, or you can put, 50% down on $1 million house and make it make sense. But for all of us listening here, we don't have that kind of cash. It's hard to make that happen, right? So for those of you that are seeing other people flaunting their wins, there's a handful of them that are actually doing well. They're getting hammered. There's a good chance you guys are probably going to start getting hammered too. I'm already getting hammered. All right. So some of the content that we're making is not purely going to be about investing in real estate. It's going to be about what's going on in the overall economy and how that affects real estate. So we know where to buy, what kind of stuff to buy, what area to buy it, and when to buy. Now, Kyle, your original question is not even what I answered. I do that all the time. But you were saying, what do you hear about what's going on in the banks?
That's right. Yeah. What are you hearing?
First off, we have a ton of people in the comments. Chris Figueroa, a couple other people. I want to keep hearing this. We actually want to bring you guys in to hear you talk about it. We're going to pick that apart. What I've been hearing is that, how do I want to put it? Like, the foundation's been very shaky. What happened with Silicon Valley Bank caused regulators to look at all the other banks, and what they saw was not good. They're seeing other banks are in the same position as Silicon Valley Bank was in. Now, we're going to watch videos. We're going to dive into this, but the gist of it, this is crazy. I was just having a conversation with someone today, and you guys may know more than me. You may have a perspective I don't have. Okay. Like, we're all getting information from different places, but what I understand so far was that Silicon Valley Bank bought a lot of bonds. So they took the money in from depositors, gave them a 0.5% interest rate. Then they would go buy a bond at 1.5% or 2%. That's a terrible rate, but if they're paying you nothing to use your money, they're still making a spread on that. Okay. That is an incredibly conservative move. No one gets criticized for making conservative moves. Buying bonds is like the safest thing you could do. All right. If we're talking about fitness, this is someone who's like, all we're eating is broccoli and celery. We are eating nothing but vegetables. That's how careful we're going to be right now. All right. The Fed has now raised rates so fast that the price of bonds goes up with it.
Yep.
The new bonds that people buy are significantly higher than all the bonds the banks were buying. They now have to offer you more money to get you to put your money in the bank. So where Silicon Valley Bank, and really every bank, could say, we'll give you 0.5% to keep your money here. Remember when that was the case? They can go buy a 2% bond and they're still making a yield. But if they have to give you 4%, Kyle, where do you think bank interest rates are? I don't even really pay attention to that too much right now.
Did you say mortgage interest rates?
Yeah. No. Like, if you go put your money in the bank, what kind of a return on your checking account?
Less than 2%.
Okay. So let's say they used to give you 0.5%. Now they give you 1.5%.
Mm-hmm.
Okay. They now have to get a bond that's at least 1% higher to make that make sense. And bonds have gone up a lot. So like we have here, Jason says Ally Bank was offering 3.75. That means they got to buy bonds that are significantly higher than 3.75 to make the spread. But the bonds they bought were at 2%. Okay. So like what happens is they're owning assets, which are supposed to be conservative, which are these bonds, which have become, I don't want to say worthless, but worth significantly less because all the new bonds are priced higher because the Fed has raised rates so fast. To people like me, this is maddening because I've been saying you can't stop inflation by raising interest rates. We've talked about how it slows the velocity of money. It doesn't actually slow inflation at all. You have to take money out of the economy to do that. Raising rates isn't the same thing as that. What you get instead, remember I use the analogy, Kyle, you've got a truck barreling down a hill and you're supposed to shift it into a lower gear, but instead you just put your foot on the brakes. And I was like, you can only do it for so long before the brake pad wears out. But everyone wants to think that they can stop the truck by putting their foot on the brakes. What you need to do is learn how to shift into a lower gear. Well, this is what happens because the brake pads are wearing out. Banks that were making conservative moves, and everyone's going to criticize these banks. They're going to say, oh, Silicon Valley went 9 months without having a credit risk manager. Guys, I've run businesses. It takes a long time to hire good people. It's very likely that they were trying very hard to hire someone. They couldn't find anyone good. And it took 9 months before they got another person. Maybe you guys know more than I do. I haven't heard anything that I was like, this is egregiously stupid. It was really that they made conservative moves. Jerome Powell and the Fed raised rates so fast and so much and at such a intensity that the assets the bank owned became worth less and less and less. And then when there was a bank run and everybody said, we want to get our money out, they couldn't sell those assets because they're not worth anything. Who buys a 2% bond when you could go get a 4 or a 5% bond because rates have gone up? That is a systemic problem that we caused ourselves. This was our government thinking they could stop the inflation that they created with COVID. And before that, with the 2008 too big to fail, raising rates in a foolish way, which is just putting your foot on the gas pedal. It does slow the truck temporarily, but it has consequences when they wear out. And now we're in a position where many other banks could be finding themselves in the same position. So what we're going to talk about today is expert opinion on what's that. We're going to react to some of the videos. And maybe we're going to get into what different things are that could happen. Does this mean that your money's not safe in a bank? Does this mean that people like me that have more than $250,000 in a bank are going to be at risk? Does this mean that the regulators are going to once again jump in and say, nope, we're going to bail out they say bailing out the banks, but they're really bailing out you, the people that have the money in the banks, right? Which guess what that's going to cause? More inflation. They're going to print more money to rescue everyone because of the decision that they made, which was crazy. So I think this is incredibly relevant for anybody who lives in America, definitely relevant for anyone who invests in real estate that wants to figure out if their tenants are going to be able to pay rent. Somebody on Instagram said inflation is transitory. Remember when we heard that? Janet Yellen tried to tell us that inflation was transitory. I've been
Yep.
As I can. That's like saying the toothpaste is out of the tube, but don't worry, it's only out for a little bit. We're going to be able to put it right back in there again. That doesn't happen. So that's basically, Kyle, that's what I've been hearing. There's always people that scream the sky is falling, but I have heard some people say that they think that the Dow and the valuation of banks can drop 30% in the next 60 days. I believe Goldman Sachs was talking about something like that. So it could get bad. Like, this is one of the first times that I've been saying, guys, don't listen to all the talk of how bad it could get. Like, no, I might be saying it could get worse than some of the other people.
And I think you hit the nail on the head. Adaptability and change is inevitable, and you're gonna have to adapt. And that's the whole reason we do these calls and these talks, because we want to be ahead of it and we want to be nimble and be able to make the moves that we need to be able to make. That being said, we want you guys to come join us too. Send a text message to the number below. You can actually come live on this call and talk with us about it. 833-777-0309. Let's jump into the first video. And if at any point, David, you want me to hit pause, I'll be ready to do that. This is a video from, we're going to do two things here. The first video, we're going to talk a little bit, break down the actual SVB crisis, the banking crisis, what that means kind of from an overall perspective to the economy. But then we're going to jump into a little bit more of a specific video regarding interest rates and housing and what that means for us in the real estate field. So let me go ahead and get this started and we will get going.
Bank regulators have seized Silicon Valley Bank in the largest bank failure since the Great Recession. Customers were rushing to take their money out.
Get the money out.
There are recent developments that concern a few banks.
What's up, you guys? It's Graham here, and in the last 24 hours, we have just witnessed one of the largest U.S. bank failures ever in history. However, what makes this so much worse is that even though it might seem like an isolated event, once you begin digging deeper, you'll begin to realize that this is a huge blind spot for the entire banking industry, with the saying, too big to fail, possibly being tested again soon. So let's talk objectively about exactly what's happening, if your money is safe, how the entire banking system could be vulnerable if people begin to withdraw their money all at the exact same time, and then finally, what you could do about this to make sure you're best protected. Although before we start, as usual, if you appreciate the information, it does help out tremendously if you subscribe, and if you want to be kept up to date on topics just like this, before I'm able to make a full video on them, I do have a newsletter down below in the description. It's totally free, it costs you nothing, it's just the information. So thank you guys so much, and now with that said, let's begin. All right, so to start, we gotta talk about Silicon Valley Bank. This was a company founded in 1982, and they quickly became a prominent lender throughout Silicon Valley while catering almost exclusively to venture capital. Essentially, this became the startups bank where CEOs and businesses would go for funding. And for the last several decades, that worked out incredibly well until recently, and you're gonna want to follow along. In 2020, when interest rates were reduced to zero and stimulus measures were put in place, both banks and people were flush with cash, and almost all of that funneled back into the banking system, which is where things began to go wrong. See, banks currently operate on what's called fractional reserve banking. This means that banks are required to keep at least 10% of their customers' money available at all times for withdrawals. Just imagine it like this. You give me your $1,000 to hold on to for safekeeping, but I could turn around and give $900 of that to somebody else, who could give $810 to somebody else, who could give $729 to somebody else. Under this situation, banks hope that enough people give them $1,000 deposits so that when the first person wants their money back, they'll have enough cash on hand to process that withdrawal. The benefit to doing this is that this allows their customers access to a much larger pool of money, and they're able to earn interest on their deposits. But that also relies on everyone having faith that the system works and not all pulling their money out at the exact same time, which has started to happen. Now, to be fair, in most cases, banks aren't lending to other banks who lend to other banks who lend to other banks. Instead, banks often take your money, loan out a portion of it, and invest the rest in really safe and stable investments like US Treasuries. This ensures that as long as those treasuries are held to maturity, the bank gets a nearly guaranteed rate of return, customers can be made whole, and everyone wins. Except in this case, and here's why. In 2021 and early 2022, Silicon Valley Bank took roughly $100 billion and invested that into government-backed bonds, with a significant portion of that locked away for 3 to 4 years at an interest rate of just 1.79%. Essentially, this meant that Silicon Valley Bank took a massive bet that the Federal Reserve was not going to raise interest rates as fast as they did. And when they turned out to be wrong, that put them in a very dangerous position. See, bonds like this are valued based on their yield, and in this case, Silicon Valley Bank was on the wrong side of the transaction to lose a lot of money. Just imagine it like this. As an example, Silicon Valley Bank took $100 and bought a 2% interest rate for 4 years. As long as they could hold it for the full 4 years, they'll receive $108.24 back and be paid in full, no problem whatsoever. But what would happen if interest rates suddenly increased right after you made your investment, and all of a sudden you could buy that exact same $100 at a 7% return and make $131 over those exact same 4 years? Well, in that case, your $100 2% bond would have to decline to $77 to be worth what you could buy at today's prices. And if you can't afford to hold out for the full 4 years to get your money back, you're going to be forced to take a loss. And that's what's starting to happen. And normally, banks would have enough capital coming in from a variety of sources to cover customer withdrawals. But in this case, Silicon Valley Bank's customer base are mainly technology companies, which have seen significantly less funding. And that means that their companies are forced to take more money out of the bank to pay for their own expenses. Essentially, Silicon Valley Bank severely misjudged the size and pace of the Federal Reserve's rate hikes while assuming that the venture capital market would continue to stay strong. That left them in a situation where they locked too much of their money away in one specific asset that yielded too low of a return. And that occurred at the exact same time their customers began withdrawing more money than they anticipated. This, of course, is where the dominoes begin to fall. On Wednesday, March 8th, the company announced that they would be selling off a third of their ownership in an effort to raise $2.25 billion. This was done in response to them being forced to take a $1.5 billion loss on a portion of their bond position, which was done to bring enough money back to the bank to be able to continue processing withdrawals. The problem, however, came on March 9th when word got out that the company could potentially be facing insolvency issues, and as a result, their stock price plummeted more than 60%, making it unlikely that the company would be able to raise additional capital to help plug the losses. At that point, the entire situation devolved into a full-scale panic. It was reported that their CEO had been calling clients to assure them that their money with the bank is safe, while startup founders had been advised to pull their money out as soon as possible, just in case. But overnight, things got even worse. On the morning of March 10th, Silicon Valley Bank announced that they had failed to raise capital and instead were looking for a buyer, meaning they quite literally ran out of money, had more withdrawals than they had cash on hand, and were looking for anyone who could potentially take them over. Unfortunately, though, that seems like too little too late, because just a few hours after that, Silicon Valley Bank was shut down and closed by regulators with the message that all of the bank's deposits have been transferred to the new bank. Of course, you might be thinking to yourself, FDIC insurance exists for a reason, and they should be able to recover up to $250,000 almost immediately. Except, yeah, that's another problem. Here's the thing, as most of you know, anytime you make a deposit within a bank, you're protected by what's called FDIC insurance, which protects up to the first $250,000 you have deposited in the event of a bank failure. This was created after the bank runs the 1920s Great Depression as a way to incentivize people to retrust the banking system, and it largely worked. Since then, FDIC insurance has continued to evolve for any bank who wants to legally operate in the United States, and the good news is that it's a fairly efficient system. In fact, their website says that you could get access to your money within a few days after the bank's closing. However, in this case, the bad news is that, as Genevieve from Grit Capital points out, only 2.7% of Silicon Valley's bank deposits are less than $250,000, meaning 97.3% of their money is not FDIC insured, and it's not clear exactly what's going to happen to all of that money. Now, typically in cases where deposits exceed the FDIC limit, losses are recovered in a bankruptcy court when assets are sold off to pay their creditors. But as Bankrate explains, that process could take several years to complete, and more than likely, their customers are not going to receive all of their money back from what they started with. Although to me, that isn't even the worst of it. Instead, it's just how far this is about to reach over the coming few days and weeks, and I have a feeling this is really only the tip of the iceberg. For those unaware, Silicon Valley Bank isn't just a bank for the average person. They are the bank for a significant portion of venture-backed companies throughout the United States. And when those businesses keep a significant portion or even all of their money with one institution, they could be completely wiped out overnight. The reality is, many of these institutions have raised millions or even tens of millions of dollars with the expectation that that's going to be enough to last them throughout these next few years. Those businesses have carefully saved money, kept it liquid for emergencies, and have spent it wisely, only to have it reduced to $250,000 overnight. From that perspective, this is going to be crippling to every single business that banks with Silicon Valley Bank, especially since they currently hold more than $342 billion worth of customer funds. Now, realistically, a startup is not going to lose all their money with the bank, and it's not like every dollar over $250,000 is suddenly worth zero, but it could take years to recover whatever's left. And whether or not the company has enough money to stay afloat in the meantime is completely up in the air. I would venture to say that most of them cannot. Just consider that everything from payroll, company expenditures, and all of their overhead could be held in one bank. And $250,000 could be a drop in the bucket for a company who would save significantly more to make it through a time of slower growth. There's really no way out of this with the exception of trying to raise cash as desperately as possible in a panic at a discount, downsizing significantly, or going under, which is something that no one thought would happen just a week ago. So that then, of course, begs the question, could the same thing happen to your bank? The answer is, it's possible, but it's unlikely. The issue with Silicon Valley Bank was that they were in a niche market servicing startups and were funded by venture capital, which was drying up. That meant that very little money was flowing in, a lot of money was flowing out, and the majority of the bank's capital was locked away in bonds for the next 4 years at a low interest rate that had declined in value. Essentially, this meant that if the bank were to wait long enough, they would have enough cash on hand and potentially absorb the short-term losses. But when everyone begins withdrawing all of their money all at the exact same time, the bank is left with no other choice other than to shut down. Now sure, in essence, every single bank operates this way and is only required to keep 10% of customer funds on hand at all times to process withdrawals. But in Silicon Valley Bank's case, they went all in on the bond market at the worst possible time, at the very peak, while their customers were moving money out of the bank during a time where they needed capital and wanted a higher return. It was really a perfect storm. For most other banks, though, the Fed Vice Chair recently said that there are obviously larger institutions that are also exposed to these risks too, but the exposure tends to be a very small part of their balance sheet. So even if they experience the same deposit outflows, they're more insulated. That's why I think in order to best protect yourself, you should never keep more than what's insured from the FDIC, which is typically $250,000 for an individual bank, or stick with one of the larger institutions who's more likely diversified and more likely to be okay. For almost all of you watching, I would venture to say that it's probably not going to make any difference whatsoever because most people don't keep more than $250,000 in cash in any given bank. But in the big picture, it's a very good example that you should never keep all of your eggs in one basket. You should always have multiple accounts in good standing with other banks just as something to fall back on. And at the end of the day, sometimes things could happen that are completely outside of your control, even if you do everything right. As far as what happens next, next is really anybody's guess. It's still unclear if it's possible for another bank to swoop in and buy them up, or if Silicon Valley Bank is deemed systemically too big to fail while the government steps in to prevent what could potentially be tens of thousands of employees losing their jobs and companies going under, or if they're going to be forced to go through bankruptcy with 97% of their customers waiting to see what's going to happen. Personally, I have very mixed feelings on this. First, I find it surprising that a bank would have the ability to lock away a substantial portion of their assets and essentially bet their customers' money on the decisions of the Federal Reserve. To me, no bank should be legally allowed to take such a sizable risk, and there should be more regulation in place to make sure that deposits are properly diversified. Second, the FDIC limit of $250,000 makes absolutely no sense to me when 97% of their depositors were above that amount to begin with. I think that business accounts should have access to significantly higher limits since, after all, they have operational expenses, payroll, and overhead to meet, not just as an individual, but for an entire company that also supports tens or even thousands of employees. In that case, it would make way more sense for the FDIC limit to be based on a percentage of what that person deposits. I mean, let's be real. A business is not operating a $10 million bank account the same way an individual would, who's probably never going to see $250,000 cash in their lifetime. That's why I think it makes way more sense to base the FDIC limits on a percentage of what they have deposited or an average account balance, just in case something happens like what we just saw. But again, all of this is likely too little too late, and the best that we could do right now is just to wait and see what happens. So with that said, you guys, thank you so much for watching. As always.
All right, couple things before we jump into that lengthy video there. Two things. I'm seeing some great comments here in the chat. Text us down at that number. I'm surprised nobody has texted us regarding this specific topic. We've got so much good information in the chats. Come in here. I want to talk to you guys. David wants to talk to you guys. Let's bring this discussion live into this video. So text the number 833-777-0309. Chris, I'm seeing some good stuff in there. William, seeing some really good stuff in there. Shoot us a text message. We want to talk with you about that. Second thing, just as a reminder, make sure you like and subscribe to this video. We're getting a lot of traction here. We got a lot of people watching right now, 120 people on a Friday night, and we want to make sure that we leave some room to continue to share this with other people. So the more you can do that, it helps the algorithm, it helps us, and it helps David grow this channel, and it helps us continue to do this on a regular basis. So David, what did you think of Graham's breakdown there of the crisis, and how did you feel like he put it for the average layperson?
I think he described what we're talking about pretty well. Graham has a way of communicating information in a very simple way because the majority of his followers are not financial experts. They're not going on to cable news to learn that. The question everybody always has is, so what do you do? Right? Like, we're always hearing the information and then we think, okay, well, what should I do? And we can probably talk about that tonight. We can give some practical things, but we don't know exactly what to do because we don't know how it's going to play out yet. What might look safe could end up not being safe later. Mark Hansen said, I'm having flashbacks to CDOs in 2008 just with cash instead of real estate. There's a lot of things that are reminding me of 2008 right now, primarily because of problem with banks, right? I heard a lot of people saying in the comments, hey, guys, we don't need you to be a complete expert on this. We just want to have a dialogue. We want to hear the questions you have. We want you to be saying, well, here's what I heard. This is what I know is going on. You guys are sharing good information, so you're educated. Just come in and ask questions of us of what do you think we could do, or what would happen if this happens or that happens. If the government does bail out banks or they bail out depositors of banks, where does that money come from? Like, that's the problem. They have to find a way to either create money or pull money from somewhere to pay for this type of stuff, which is going to create more currency, which is going to create more inflation. And I can easily see us getting into a stupid spiral of printing money while Jerome Powell raises rates. So what you have is asset prices going up, the price of food going up, everything becoming more expensive, but the cost of borrowing going up as they keep increasing rates at the same time, and they don't stop prices from going up, but they make it incredibly hard to borrow money. And in that case, it's the people that have the cash are going to do well. and it's that investor who wants that FHA loan that only has 3.5% to put down, the person that's been following bigger pockets that's with us right now, that's saying, I don't have a lot of money, I want to be able to borrow the money to buy the house, that will find themselves in the worst position. Because if he keeps raising rates and mortgages are at 16, 17, 18, 19%, but inflation just keeps going up and we don't have enough houses, so no one's selling them, like that doesn't mean people are going to put their house on the market. You know, like if you've got an interest rate at 3% and rates are at 19%, do you want to sell your house and go get another loan at 19%? Probably not. So we're taking inventory out of the supply pool because people don't want to sell if they have low rates. We're making it harder for people to buy real estate. We're also hearing the Biden administration talking about wanting to get rid of the 1031 exchange. Now you got to sell your house, buy it at a higher rate, and pay taxes on that because you can't 1031 into something more. So that's even more supply that's coming off the market. You see what I'm saying, guys? We may have these really high rates, but not see it real estate prices come down. I don't know that's going to happen, but like that's a concern that I have when I'm listening to this, where we're playing so much instead of just letting things work themselves out. So I thought Graham did a good job of explaining this is what's going on. It doesn't tell us what we should do, right? Now, one of the things I do know you can do is that fundamentals always work. I can't control what's going on in the market. I can control what's going on in my own household. I can't control what's going on with real estate deals. I can control what I spend my money on. I can control how hard I work when I go to work. I can control how I deal with the anxiety that comes my way. And so at this point, that's where my focus is, all right, we should be expecting things to go bad. How do we build a fortress so that we're insulated when that bad happens? Because I think we're going to see more and more and more talk of this happening. Now, as that happens, people get scared. As people get scared, they're likely to want to go take their money out of banks. We call that a bank run, when everyone goes to withdraw their money at the same time. That can create a self-fulfilling prophecy where now the banks do start running out of liquid assets that can't pay people back. And the federal government says, we got to step in and create calmness. We got to get rid of panic in the market. So we have to insure everyone's deposits, and everyone pulls cash out of their banks and keeps it at their house. And then thieves all know, well, we'll just go steal people's money because now they got $100,000 under the mattress instead of $400, right? So like, what's that going to look like? If everyone takes their money out of the bank, where are they going to put it? Are these areas that defunded police, these areas that like said, we don't want a law enforcement presence, are they going to get hit really hard? What are those people going to do with all their money? Like, this could unwind pretty quick just from human beings spiraling into a place of fear. What about you, Kyle? What were some of your thoughts?
Yeah, to dovetail off of what you're saying, I think some of the conversations that I've been having with people, especially in the mastermind in Spartan League, is you want to be aware of what's going on, but you don't want to be in fear. And I like what you said. Like, first of all, you got to take care of yourself first, right? If you're in this fight or flight panic mode all the time, you're not going to be able to make safe, sound, confident decisions. So you got to make sure you're doing what you need to do. And like for me, you and David, that's working out in the gym. For me, that's like even doing yoga, right? Just centering myself, getting myself in a good place where I'm not freaking out all the time. But the second thing is you should really be taking the time to take a hard look at your personal finances, but look at your business finances too. Is there a lot of bloat or areas that you're maybe spending too much? This is the time right now to cut back on a lot of the things that you really don't need. If you're taking a flight somewhere, can you drive there instead, right? Instead of driving to the store, can you walk instead? Right. So take a really good look and a second look, a really hard look at your finances and what's going on there. Take some time to prune some of those branches. We're coming into a pruning season. It feels like we're coming into a changing season, and you got to have good offense, but you also got to have good defense. And part of that is taking a really hard look at your subscriptions, all of your expenses, and figuring out which ones are actually wants and which ones are needs.
All right. Thank you, Chris, for having the courage to come on first, man. I love it.
Chris, what's going on, my man? Spartan League member.
Hey, what's up?
So tell us your thoughts, man. What are your thoughts on all this stuff?
Man, everything's kind of crazy, but you can only worry about what's within your control. So that's what I'm doing. And keeping up with all the information that y'all are providing, like the Bigger Pockets episode earlier with Jay Scott. I like his perspective. It made me feel better about everything. Keeping up with, like, for example, Graham, you know how he mentioned the what do you call it, his email. So
Yeah.
I've been like, just like, I signed up for that, and he gives out a lot of useful information. So and there's also like market briefs and business briefs from Minority Mindset. So I feel like, just like, I take all the information in, and then even if I don't understand, slowly, like, the more you just like keep reading, you'll just start picking up on it. But basically, you can't really like stress out about what you can't control. So you gotta just do what you can. And like you guys are saying all the time, if y'all just focus on your own growth, then you're fine, basically. Because it's like that, nothing can really stop you if you're just like continuing to like move forward and improve yourself. So that's my take on it. Don't be scared about what's going on out there, because there's only so much that you could do. So just focus on becoming better, like everything you guys promote, basically. That's my take.
All right, Chris. Thanks, man. We appreciate it. So you said you subscribe to Graham's email. You watch what was it? Minority what?
Minority Mindset. So Jaspreet Singh, he has business briefs and market briefs. So he sends out like a daily email and just like keeps you updated on like what's going on in the market. That's also free. Every YouTube video that y'all put out, I be trying to watch like at least one a day. At minimum, like one a day. Like, if I could do more, the better. But just basically keeping all that information. And I got your books too.
All three of them, man.
Awesome.
Yeah, I got 2 sold ones.
The red, blue, and green.
Yeah.
Cool, man. We'll keep up all the good work, Chris, and appreciate that. And we'll see you on Monday at the Mastermind.
But I'll see ya.
All right, dude. I think he brings up a good point. Like, you got to make sure you educate yourself with what's going on out there, right? And make sure you get your information from the right sources. That's another important thing. And then make sure that you are doing your homework and learning about how the banking system actually works, how the economy functions. And there's a lot of really good stuff that you can do. So I love it. And I like that he's always learning too.
Yeah,
I know.
Is not the time to not pay attention. This is not the time to say, "Oh, I'm not paying attention to any of that." Like, this is when you need to be paying the most attention.
Absolutely. By the way, we have Marnie's going to try to join us here in a second. She's trying to get connected, and then our good friend Jason Wallahan, he's got some ideas too. He's going to get on here in about 5 minutes. So I'm really liking this topic, though. I think there's a lot of really good points. What are your thoughts in terms of how it's going to affect real estate, David? We've talked a little bit about inflation and how it affects the money that you have. What are your thoughts on real estate impacts?
Well, the first thing you have to think about is liquidity. Okay, so when I say liquidity, what I'm referring to is how much money there is to pass around from person to person. Think about like the oil in your car. If your car runs out of oil or runs low on oil, it will still run, but damage will start to be done to the engine. It doesn't run very well. You want the right amount of oil in your car. What we had in 2008, the whole Big Short issue with the too big to fail, it isn't just that the government was concerned, we have to protect the bank, okay? Like, that's always the way that it gets spoken about, and we're angry at the bankers and the bad loans. Of course, they were idiots and they did bad stuff, but it's important to understand someone's real motives. The government knew if the banks go down, it's like putting a hole in your car's oil system. It's all going to leak. You have an oil leak. The car will grind to a halt. We have to keep money flowing from person to person. So that's why they bailed them out. They didn't give banks a bunch of money to protect the bank, which is what like the angry people always think. They gave the bank money so that banks would lend it to people. What we have to worry about in this situation is if banks start failing, it gets harder and harder to get a loan to buy real estate. And because things like real estate are incredibly sensitive to both inflation and interest rates, both things that we're talking about right now. The value of your home, it goes up if interest rates are low, and it goes up if you have inflation. And it goes the other way. If you take money out of the economy or rates go up, it makes the value of your asset go down, because people don't pay money for a house, they buy a monthly payment. That's how this works. The same is true of cars, which you see a similar situation happening in the pattern of vehicles that you have with real estate. There's not enough supply. There's too much demand. The financing is expensive for them. So the cars are very expensive right now too. And inflation, right? So with real estate, we don't have enough supply. If the banks go down and it's difficult for investors or homeowners to get a loan to buy the house, less of them will be out there able to buy property, which means the value of real estate will become inherently lower. But that doesn't help you if you're listening to this, if the values go down, because there's less buyers for every house, if you can't get a loan to buy it. Only the people with a ton of cash are going to be able to do everything, and they're not going to go pay like 10% less than fair market value. They're going to want an incredible deal, which means the government probably isn't going to let that happen. They're probably not going to let that liquidity dry up. They're probably going to come in and do some form of bailout, which will lead to even more of the problem that they've been trying to fix. So that's how I think it's going to affect investors, and that's why I'm watching this super, super carefully.
Love that. Before we jump into the next video, I want to bring Marnie on, and then we are going to watch the next video a little bit more about how this is affecting real estate, specifically mortgage rates, but also the prices of housing as well. So Marnie, welcome to the show. Thanks for hanging out with us.
Hi. I'm not camera ready today, so.
Well, we appreciate that you accommodated my request and you came in even though you're not camera ready. That just speaks to your character. So
Great.
Thank you.
Great. What can I do for you? I don't know what questions. What are we going to talk about?
Well, you seem very educated on this topic. It seems like you've been following it. So if you wouldn't mind, can you just share kind of like what you've been accumulating so far and what your thoughts are?
Yeah. A couple of things I put in the comments. I think that someone else said that there's kind of this mass hysteria, right? And I think that's the crux of the problem. Even with the Silicon Valley Bank problem, it wouldn't have been a problem if people didn't start all withdrawing their money at the same time. And just kind of looking at what the government's reaction has been, I think that they did what they needed to do and that they're covering the deposits. Not that that's necessarily what I think is right, but I think they needed to, because if they didn't, that would just completely shatter everyone's, faith that their banks are safe or that their money is safe in their banks. And so there would just be these mass runs on banks. And as we heard, and as most people know, banks don't carry 100% of reserves. They carry a very small percentage of reserves. So if everyone tries to pull all of their money out of every bank, we're going to have a big problem. So I think what they tried to do was they tried to stop the leak, right? So they tried to plug up the hole in Silicon Valley Bank and, try to contain it that one spot so that it didn't become a bigger systemic problem.
Yeah, that would make sense, right? Like when we say, well, why would they bail them out? Well, if they don't, everyone else panics, and every other bank has the same thing happen, where if they say, no, it's cool, you're fine. Now I don't feel the need to go pull $1 million out of the bank and stick it in my safe somewhere, which, like I said earlier, can you imagine if that just became well known that everybody was taking their money out of a bank, what home invasion robberies would do?
Right. But I mean, what's the alternative? So, okay, great. Even if you had a safe place at home to keep your money, you're still losing at the rate of inflation, right? Mm-hmm. Your cash is not going to earn any money sitting at home under your mattress or in your safe or wherever it is. Yes. So it's that it's not safe in your home. It's that it's actually losing value when you don't have it somewhere in any sort of vehicle that's going to be increasing its value.
That is such a good point. And that right there is why I really think we need to be paying attention to what's going on, because this is not good news. There isn't a safe place right now. Okay. You go put your money in, you leave it in the bank. There's a chance that you could lose it. And even then they're not paying you the rate of inflation. You take it out of the bank, it's even worse. And you're not safe because you now become a target. You go buy real estate with it. That real estate could become worth less than what you paid. You also now run into the problem where your tenant may not be able to pay their rent because if they work in tech, they might be getting laid off. You go buy stocks with it and you're probably below the rate of inflation, and you're at risk that if we do have a banking failure, the stock market's going to get absolutely destroyed. You see where I'm going? Like, you start running out of options that are, you go buy bonds. Well, they're increasing the interest rate so fast that the bonds you thought were a safe bet become a bad bet, just like it was for these other banks. There isn't a safe place to put your money. You could try gold, you could try Bitcoin. In fact, I wouldn't be surprised if we see a Bitcoin run if this gets worse. But like, is that safe? You got to time that perfectly, right? How many people were buying Bitcoin at like $60 or whatever it was? It's like, was it six? No, I'm trying to think of like where's it at right now? About 25.
Yeah,
25,000 a Bitcoin or so.
27,000.
They were at like,
yeah.
27. Okay. So that's gone up, right? It's already starting to go up because we're hearing the stock, but when it goes down, you can't stop it. It could drop from 60,000 to 10,000. That's not a safe option either. You can pay off your interest rate, but you probably have a rate of 3%. Why would you want to pay that off? It becomes very, very difficult to think of like, where's the safe bet, which is why a lot of the advice that we're giving is like, well, what you can control is where you're spending your money and how much of it you're saving. So Marnie, like, is there a certain metric you're looking at? Is there a certain thing you're waiting for the news to say that's going to help you make a decision on what to expect?
So just talking about the news, like, I think that there is so much mass hysteria and so many things are triggered by what the headlines are, right? And so, you were even bringing up layoffs. Like, yes, there are tech companies that have been announcing layoffs. I live in a tech sector. I've always lived in a tech sector. They're not as massive as the news makes them sound, right? I work and sell real estate in a very tech heavy city. And, it's, yes, but I live in Seattle. Headquarters of Amazon are here. Amazon is not crashing. It's not falling apart. Microsoft is not crashing. Facebook's not crashing. All of these companies that grew so exponentially over the past couple of years, they're just kind of evening out right now. But the news is making it sound like there's this catastrophe that's happening and everyone's laid off and there's no money, but there's still plenty of money flowing. It's just that you can't buy into the hype and the hysteria. And, I think that what's really going to change is that the people who are looking for the overnight success, the fast money, they want to buy Bitcoin at $2 a share and make $60 or a coin, whatever.
Yep. Yeah.
Those people are the ones that are going to, see these huge losses or they're going to feel like they missed out. But I think when you kind of pick the tried and true methods and you stick with the things that are, maybe I don't even want to say too conservative, but the things that don't have the huge swings one way or another, you're going to be safe.
When you're not trying to outsmart the market is what you're saying.
Totally.
Yeah. I think that's a very good point, that what would cause a banking failure would likely be if everyone panicked, which really isn't different than other things in life. Like, are you safe when you go to the movie theater? Yeah, until there's a stampede, right? If someone screams fire, now you're not safe anymore. You could get trampled underfoot. Like, going through society, there's never a time you're actually safe. Remember, you probably felt safe about getting toilet paper and then COVID hit and all of a sudden you didn't feel safe anymore. You're like walking through Safeway with 3 arms full of toilet paper. People realize it's the last one. You're getting tackled and jumped. It could be rough out there. It's human beings panicking that caused the problem at Silicon Valley Bank. And that, like you're saying, I think you're like, everyone should stay calm. We don't need more of that because it could panic again. I don't know, but my gut would tell me if that does happen, it wouldn't cause a systemic problem. It would cause a temporary problem. If people panicked and there was a bank run and they did go try to take their money out and banks did get in trouble, we would just rebound right after that when everybody calmed down, right? It's not a situation that's like the whole economy is going to come grinding to a halt. It's more the ways that we've been accustomed to making money or handling finances are being challenged. I would look at it like that. Conventional wisdom is being challenged. I was just shocked. I'm like, what was Silicon Valley Bank's biggest sin? Well, they bought too many bonds. You're like,
truthfully, I mean, I don't know all the details, but it really looked like they went too conservative. They had a huge influx of deposits. So one of the other things I said in the comments was, banks of a certain size are subject to these stress tests. And a couple of years ago, they weren't big enough to be subject to the same stress tests that some of the biggest banks were. And so they weren't being tested in the same way. Well, then they've got this huge influx of deposits over the last 18 months, and they had to do something with the money. And so they were trying to be responsible and conservative, and they put it in bonds, except bond rates were very low. And if they were able to leave the money in the bonds for that period of time till they matured, they would have been okay. But everyone tried to pull their money too fast.
Yes.
So, you know,
I mean, we started off the show saying that this is like finding out that you ate too much broccoli and it made you sick. You're like, what? How could that happen? I thought broccoli is what I'm supposed to be eating. Like when I first heard about this, I thought, oh, they made loans to tech companies that went bad. They invested in the wrong businesses is what I was thinking I was going to hear. And I kept waiting for that. Like, oh, they bought, you know, they made a loan to this competitor of Uber and it turned into another FTX. That's what I thought I was going to hear when I heard about the bank going down. And when they said, oh, they bought too many bonds, I thought, you can eat too much broccoli. You could get broccoli poisoning. That's crazy. It was literally us raising rates as fast as we did that made their asset worth less than it was when they bought it. And how do you blame someone? Now, also, guys, if you're watching this video, more information could have come out. We could have realized it was worse than what we thought. I don't know everything about what was going on with Silicon Valley Bank, but what we're being told, there's this line in Bad Boys 2 where I don't remember who the bad guy is, but he's this drug kingpin, and he's got all this cash that he's trying to keep at his house. And Will Smith and Martin Lawrence are undercover cops, and they're trying to find a way to sneak in. And so they pretend to be a pest control company that are coming in to kill these rats because the rats are eating his money. And he has this line where he says, the rats are eating all my effing money. This is a stupid problem to have. And I just thought that was one of the funniest things I've ever heard. This is a stupid problem to have. Like, you shouldn't have to worry about rats eating money. That's not a thing that you prepare when you're looking at what could go wrong. Nobody expects that buying too many bonds could lead to a major disruption. So I think you made a great point, Marnie. It was literally the panic that exposed this, but we do need to recognize human nature, and people do have a tendency to follow the herd. They do have a tendency to rush in the same direction. It's like if you ever watch, you know, when animals are running and they panic and they all just run over their own young and they run right off cliffs. Like they're just not thinking. I like your take here that everyone needs to take a deep breath, recognize that, yes, rates are going up really fast. That's what the Fed's doing. It could cause some of these problems, but it only gets bad if we make it bad.
Right. And I mean, think one other point, not to say that I love the fact that rates are going up and not to say that the Fed is, you know, perfect at what they do, but the point of them raising rates is trying to slow down inflation. So what they're doing by raising rates is working. It's just, it's a bad situation to be in, right?
So, I think they just raised them a little too much and too fast. Yeah. Had they raised them at a slower pace, I don't think this would have happened to Silicon Valley Bank.
They started too late and then they raised them too fast.
Yes. So I use the analogy of a truck going down a hill. The best way to slow it down is to shift into a lower gear, but it's always tempting to just step on the brakes. Raising interest rates is similar to stepping on the brakes. You're trying to slow things down, but you can have these unintended consequences where your brake pad wears out. They just stood on them too hard. And so there could be several other banks that went, and this is the case for every investor, even in real estate. When you sit down and analyze your deal, let's say you're buying a short-term rental, you look at the numbers of how many people visited, you look at AirDNA, you look at Price Labs, you run all your numbers. Let's say you're an apartment complex owner. You look at what everybody else is paying for rent. You come up with your income. Then you look at the interest rates. You look at your expenses, everything. You make sure you're making more money than you're spending. You divide it by how much money you're going to put in there. You get an ROI, and you use that number to make your decision, okay? What makes things tricky is when the rules change after you bought the property. You bought a short-term rental, and then everybody else went and bought one there in the next 2 years. And so what looked like you were going to make a certain amount of money, you're making half as much because there's all this competition that wasn't there when you made the decision. Or you buy an apartment complex, and then they build a whole bunch more of them in the same area, and you were getting $1,900 per unit. Now you can only get $1,300 per unit. That doesn't always mean that people are stupid. Change can make this happen, right? So that's one of the reasons that we talk about needing to get this information, because you want to be aware of that. And I think, Marnie, you made some really good points. Is there anything else you want to leave us with before we let you get out of here?
No, that's it. Thanks for making.
You're awesome, by the way. I hope that we get you back on here more.
Come back,
really appreciate you coming in.
Sure, happy to.
Thanks, Marnie.
Thanks.
See ya.
Bye.
All right, we got Jason hanging out, but before we bring Jason in, I want to start the next video and get it going, and then ask Jason's personal opinion on this. Jason's an active real estate investor and also a longtime member of the Spartan League. So he's going to be a great person to bring on. So let's start the video and then we will get it going.
Directly our housing market. So I want to share this with you guys. It says the Dow Jones closed more than 300 points lower on Friday, posting its worst week since June, as Silicon Valley Bank collapse would cause a sell-off for the stock market. So, for example, the stock market tumbled on Friday as tech-focused lender Silicon Valley Bank shut down, following losses in its bond portfolio, prompting the biggest bank failure since the global financial crisis of 2008. And because of this, the Dow Jones fell 345 points on Friday, which is a decrease of 1.07%. The S&P 500 decreased by 1.45%, and the NASDAQ fell by 1.76%. Therefore, for the week, the Dow Jones fell by 4.4%, posting its worst weekly performance since June of last year. Regulators took control of Silicon Valley Bank on Friday after shares tumbled on Thursday, and the bank struggled on Friday to find another company to buy it. And this collapse of Silicon Valley Bank overshadowed February's jobs report, which is also announced on Friday. In that jobs report, they showed actually signs that inflation could be slowing. Payrolls increased more than expected, but investors focused on the smaller than expected gain in wages, which may cause the Fed to rethink its aggressive stance on rate hikes this year. And speaking of February's jobs report, it was reported that non-farm payrolls increased by 311,000 for the month, above the 225,000 that was estimated. However, though, there was some good signs on the inflation side, though, because hourly earnings climbed 4.6% from a year ago, below the estimate of a gain of 4.8%. Also, the monthly increase of wage gains was an increase of 0.2%, also below the 0.4% estimate. So the reason why I'm mentioning this in today's video is this really is going to be impacting rates. Because look at this, the 10-year treasury as of Friday decreased by 22 basis points down to 3.70%. It was really close to 4% on March 1st of this year. So just about 1 week ago, the 10-year treasury was around 4%. Now it's at 3.7%. And this is really impacting mortgage rates. Look at this. According to the Mortgage News Daily for Friday, average 30-year fixed decreased 24 basis points. Now it's at 6.76% for people with exceptional credit, of course. Jumbo is at 6.35%, and FHA and VA is at 6.25%. So this means that over the span of the past 2 days, average 30-year fixed rates have decreased by about 30 basis points, going from just over 7% just a few days ago. Now they're at 6.76%. This means compared to 1 year ago, that rates have only increased by 2.48 percentage points compared to 12 months ago. 12 months ago, average rates were at 4.28%. Also, because of this fallout of Silicon Valley Bank and because regulators have taken control of it right now, the street is now forecasting the Fed is going to increase the federal funds rate by only 25 basis points in about a week and a half from now. Yesterday, they were forecasting for the Fed increase rates by 50 basis points. So on Friday, now the expectation is, with a probability of about 60%, is that the Fed is going to increase rates to 5%. That's a 25 basis point rate hike. In contrast, on Thursday, the street was expecting a 50 basis point rate hike. Now it has been completely reversed. Now they're expecting a 25 basis point rate hike in their next meeting. Also, for their next meeting, or so for their May meeting, they're expecting the Fed increase rates by 25 basis points once again by a probability of 57%. Then in June, or in mid-June, they're also forecasting the Fed raise rates by another 25 basis points. So on Thursday, the street was forecasting for a 50 basis point rate hike later this month, followed by 2 consecutive 25 basis point increases. Now the forecast is for 3 consecutive 25 basis point rate hikes. And again, the reason why I'm sharing this information with you guys in today's video is this right here, this giant decrease in rates by 24 basis points on Friday. If the trajectory continues to go downward, in other words, if rates continue to decrease, that could cause home buying demand to increase like we once saw in the beginning of February this year. But of course, time will tell, and I'll definitely keep you posted because in my personal opinion, the direction of our housing market this year is going to be largely impacted by the direction of mortgage rates this year as well. And changing gears here, let's also talk about some other reports here as well. So I also want to kind of focus on some early indications of home buying demand in today's video. So according to Showing Time, which tracks real estate showings across North America, for the week ended March 9th, the number of home showings by real estate agents across North America increased by 18.3% compared to the first week this year. Compare this to 2022. At this time, we had a 24.2% increase. Back in 2020, this time, right before the onset of COVID, at this time, we had a 30.4% increase. So in other words, this year, we have 18% more real estate showings over the past 7 days compared to the first week this year, which is an increase, of course, but well below the past several years. So that was the number of real estate showings across North America, according to Showing Time. Let's also have a look at pending home sales, which of course is a measure of contracts being signed between buyers and sellers. So for the week ended March 5th, pending home sales are down by 29% compared to the same week of 2022. It's also interesting to see here that the total number of pending home sales is more or less in line with 2020, but again, far below 2022, which is in black, and far below 2021 right here as well. So for example, in early March of 2022, there's approximately 60,725 pending home sales. Now there's approximately 43,000, a decrease of 29.1%. And again, it's worth mentioning here that contracts being signed is still increasing, but not increasing at the same rates over the past several years. And of course, it's worth mentioning here that contracts being signed are still increasing, but not at the same rates we saw back in 2022 or 2021. So it appears we're had this kind of a seasonal uptick in home buying demand, but still well below the past couple of years. So that's information regarding the demand side. Let's have a look at the supply side. So new listings, according to Redfin, have decreased by about 22%. New listings were increasing right here. They are still increasing, but not the same rates. So the number of new listings we have right now are far below 2020 through 2022. I mentioned that in a previous video, but I want to mention that because the reason for that is right here. This is according to a new report that was posted on March 6th by Black Knight, which is a data analytics firm that supports the real estate and mortgage industries. So according to them, half of all mortgage homes, in other words, people who have loans on their houses, half of those have rates at or below 3.5%. And also 2/3 are at 4% or lower. So the reason why people are not listing their house for sale is, of course, because the vast majority of people have rates below 4%, whereas right now rates are about 6.75%. Therefore, because rates are so much higher right now compared to the rates that people have right now, people are holding on their houses and are deciding not to move, or instead of selling their houses, they're deciding to rent out their properties. So what we have right now is kind of this tug and pull with buyers and sellers. We're seeing a decrease of contracts being signed. We're also seeing this huge decrease of home sellers who are selling their houses, or I should say homeowners who are deciding not to sell their houses. So kind of have this tug and pull between buyers and sellers right now, a decrease in demand, but also a decrease in supply as well. And speaking of supply, it's going to be really interesting to see what happens with housing inventory over the next month or two, because right now is a time frame when inventory tends to increase. Obviously, it decreases during the winter months, but it tends to increase in the spring months. So looking back at 2019, for example, which is March 8th, 2019, just after that, housing inventory started to increase. We also saw that back in 2018 as well. Back then, there was approximately 790,000 houses for sale. And after that, especially during the spring home buying season, inventory increased. That happens every single year, except for, of course, 2020, where we had COVID lockdowns. But it's going to be interesting to see in March and especially in April, whether or not housing inventory starts increasing, because it has been decreasing. So over the span of the past 12 months, inventory has been more or less decreasing ever since November last year, which again, is entirely normal, but we should see this slight uptick or increase in March this year. But if inventory does not increase, this is likely due to the fact that people do not want to give up their historically low rates, because new listings have been decreasing greatly this year. The reason why I'm talking about this is that
All right. Couple things I want to talk about regarding that. First of all, I think he has a really good analysis, really good breakdown of the way it's affecting real estate. It's pretty interesting because a lot of times we assume, oh, if supply is high, demand is going to be low, or vice versa. But in what we're seeing right now is demand is low, but supply is also low, right? And it's not going to be what it was when it was with COVID, with everything being super hot. I'm really curious for what you guys think. Put it in the comments in terms of what your opinion is and how it's affecting real estate. I can tell you from a real estate agent perspective, what we're seeing on the David Green team, both in NorCal and in SoCal, we're seeing exactly what Jason here talked about, which is there is a low supply. There's less houses on the market than what we have traditionally seen. I do think, though, there has been an uptick in the last few weeks for us. Our showings have also increased. So his data of what he's showing, by the way, he's using this website called Showing Time. And a lot of you that maybe don't know, it's actually an app that real estate agents get on their phone, and it allows them to basically track showings. And Zillow bought this software company called Showing Time. So they use that to track analytics and how many showings are occurring. Because a lot of times if you see showings increase, that means that there's more buyers on the market. On the lending side of the world, they'll use how many pre-approval applications are being processed at any given time. So I do think there is going to be an uptick, but I'm also curious, David, have you seen the memes going around? It feels like there's a lot of memes going around about people who are stuck in their house and they don't want to give up that 2 or 3% interest rate. And so they're like, I'm not selling, I'm staying here. And they're almost like, enslaved with where they're staying.
I haven't seen those, but that's funny. I did talk about that a lot when we had the big run in real estate. I'm going to bring in Jason as we talk about it, where if you think about the last 8 years, let's look at every single thing that contributed to real estate prices increasing. Okay. First, you had the too big to fail quantitative easing stimulus, where when I say they print dollars, what I'm really saying is they created money, which makes money worth less. That is what's happening in Argentina that Nadia mentioned. We can talk about that later tonight if there's some time. But imagine like your girl wants you to get her a diamond ring to get married. Okay. Ladies, why do you all like diamonds? Well, part of it is because they sparkle. But what's the other reason? What's the reason, Jason, that women like diamonds?
Because they're priceless.
They're priceless. That means they're freaking expensive, right? So you spend a lot of money on it. It's something she gets to wear that shows I'm valuable, right? That's why we buy diamonds as engagement rings and as wedding rings. Well, what would happen if we took the amount of diamonds in circulations and we made 10 times as many diamonds as there are? Do you think diamonds would continue to stay at the same price? It's impossible. If you flood the market with diamonds, diamonds become worth less. For some reason, people think dollars work differently than that. They don't. It's all the same thing, okay? Now, that doesn't mean that everyone would realize the market had been flooded with diamonds. You wouldn't tell anybody. What happens is people just start to realize, man, every time I go to that store, and I try to hassle for this diamond, the guy, he always gives me the deal. That's weird. Right now, if you want to go buy a Rolex, good luck. There are no Rolexes out there. You can't get them. You're not only not going to get a lower price, you're going to pay more than what you thought. And you're going to have to sweet talk the guy to even get in the line. If you're a watch person, I'm not, but if you are, you know this kind of stuff. Well, what happened if every time you went in to get a diamond, you're like, I see it's 5,000. You think you could do less? And the guy's like thinking, well, I got like a whole storeroom full of these things in the back. I want to hit my sales quota. He's like, yeah, I'll do 3. You're like, $5,000 to $3,000. Hell yeah, I'll take that. Like, maybe I'll buy 2 of them, right? You buy 2 diamonds. And so like you have both of those diamonds made into a ring. And then every other girl sees your girlfriend has 2 diamonds on her rings. And well, I want that too. And everyone else starts to realize the same thing. Eventually it gets out. You could get a deal on diamonds. Then we start to investigate. We're like, oh, we flooded the market with diamonds. All right. Inflation works the same way. You make a lot of dollars. They're not worth as much. It doesn't come out right away. People start to realize they can ask more for wages. Companies start to realize, well, that person's charging me more. Like, if you guys have noticed how much food costs, like you go to Taco Bell or the grocery store, and like what used to be a $3 thing is like a $6 thing. It's a lot more expensive. It took a couple years for us to figure out that we could charge more, but we do. That was one reason that real estate went up. You also had, they kept lowering rates. Obviously, that makes real estate affordable. Then they didn't make enough supply. That's another problem that they had. Okay, then they have the only way to save in taxes is with these cost segregation studies and bonus depreciation. Then you had Airbnb come along, and now you can buy a house that isn't a house. It's now a business. Right. So if you had a house that you bought and now it was worth 400, but they've lowered rates and inflation happened. So your house went from 400 to 700. All right. Let's say it was worth 400. You owed 300. It went up to 700. Now you have $400,000 of equity. Well, you'll sell it and you'll buy another house for 1.3 million or 2 houses. Right. And they still make sense. They're still going up in value. Then you see how fast inflation's taken off. You're like, well, I got to buy more real estate because that's the safest place to put my money. Every time you sold your house, you had a bunch of equity. And then you sold at a 4.5% rate to get into a 3.2% rate. Every single thing was going in our favor as real estate owners. So we're more likely to keep buying more properties. Well, what we're seeing right now is rates have gone up, like what Kyle just said. You're going to sell your house maybe for less than what it was worth before, which sucks. You don't like it, but you definitely don't want to go buy a house after you sold your house for less than what you thought it was worth. It's off the peak. Now you got to take out an interest rate twice what you have right now, so you don't sell. What it means is there's less inventory that hits the market. So even though homes are unaffordable, there's not a lot of them. They're still scarce. They're still rare compared to like what it could be when in 2010, when there was just way too many homes. There wasn't enough buyers. So it's working against homes ever being affordable. This is what I was scared of. I used to say on the podcast, my fear is we get to a point where only the wealthy can buy a house because we don't have enough of them. And the situation is like nobody that owns them wants to put them back on the market. Can you imagine if you lived in Argentina? Would you want to sell a house right now? Like, it's so bad over there. When you go to buy a bag of rice or a newspaper or a gallon of milk, you don't know the price until you go up to the person at the desk. That is how bad it is. Like, they can't even put the price out there and say, this is how much your newspaper subscription will cost for the year, because it adjusts daily, right? You want to own hard assets if inflation gets that bad. And since we're probably going to have to print our way out of this mess we're causing right now, we're likely to see even more inflation coming. So I haven't seen the memes, Kyle, but this is something we've been talking about for a while. Doesn't mean right now is the perfect time to jump in to buy a house, because we don't know at what point this happens, right? Like, I'm not saying drop everything you're doing and buy real estate. It could get worse. But long term, if we keep printing money, it's likely to get to the point where you have to own a hard asset or you're not going to know what to do. Like, people aren't going to be negotiating their contracts like teachers, where they negotiate a contract for the next 5 years because they don't know what inflation is going to be. So they're not going to take a 3% raise every year if inflation's at 20%. Jason, thank you for joining us. What are your thoughts so far?
Whew. Well, that's a lot.
By the way, before Jason jumps in, I just want to say he made a sacrifice to come on and hang out with us tonight. He was willing to put aside putting down the kids' duty and even spending some valuable time with his wife to come in and chat with us. So thanks for coming out and hanging.
Yeah, well, shout out to my wife for that. I'll let her watch the replay and she can hear the shout out. So
nice.
Yeah, she took care of that for us. So yeah, so my thoughts. I mean, I'm with you, David. I think that hindsight. Well, I mean, it's hindsight for a lot of us. I know that you've been saying this for a while. Even at BPCon last year, you got your 5 minutes of of a past recording where you basically called out what was going to happen, right? And you were spot on. And so kudos to you for that. But I think that for the majority of us, and I'll just speak from me, I guess. We are fortunate that we're on a Friday night, YouTube Live, and this is the place that we choose to spend our time. And because of that, one, we're a little bit more educated in what's going on, but there is a downside of that in that we get a little bit more in the weeds. We kind of overthink it because we think that everyone else is thinking the same thing that we are, and we become somewhat, and we project. I think we project those thoughts on other buyers and other sellers when we're investing, which is good, but a lot of people are just looking for their first home or maybe their step up home, and I think that some of this will pass. Like, I think that those that have if we have multiple properties at 3.5% interest rates, we're going to miss those times. But eventually 6% is going to become the norm again. And I think that people will jump back in and we'll get back to a normal. And people won't be saying, I can't leave because I'm waiting for rates to go back down to 3.5. But I do also, at the same time, think that I'm concerned about the dominoes that fall because of all the things we've been talking about tonight. The policy changes that happen, the way that people rush to, an asset class maybe, or the downstream effects of, okay, we need to do things like have rent control, or we need to get rid of the 1031, because these are things that, make it hard for people to get, into housing. And I think that when we have things like the Silicon Valley Bank incident, it's easy to stand on a platform and say, okay, this is what needs to be done about it, without thinking about the downstream consequences, or we need to print more money, without thinking about the downstream consequences to everyone, not just the niche that particular politician might be serving.
So what are your thoughts on what's going to happen if we have a change of president? Like, if we have a different president, Joe Biden doesn't win for the next 4 years?
Well, the cynical part of me thinks that, the logical thing to do in the next year and a half would be to raise rates for 2023. And then, as you go into a campaign year, you start buying goodwill and, and you start lowering rates,
right.
Which, then increases inflation. But if you can get a win in 2024, then, it might be worth it. So I think that, I'm not an economist, but I think that if I were a politician, that's the way that I would be thinking. So I wouldn't be surprised to see that. And then if there's a change, either that, or the opposing party is going to run a campaign that is, once I get in, I will lower them. So I think 2024, 2025, we could start seeing a decrease in rates.
Yeah, and I think if we don't, whoever wins the next presidency, assuming it's a change, is probably going to come in, and the first thing they're going to do is lower rates to get started off on a good, it's going to make them look really good if we've raised rates and then they come in and lower it. So that's one of the reasons that we say real estate is really good as an investment over time. But you do hit these crunches like what we could be going into right now, where it could be really tough. So the way you survive that is you have a lot of money in reserves, you keep saving, you live beneath your means, you get rid of this idea that real estate's supposed to be purely passive. I know, Jason, that you're is it Florida where you have your short-term rental?
I have one in Florida and one in Tennessee.
But you've been in Florida, right?
Yeah, I've been in Florida. I've been in Florida less than I've been in Tennessee. I've been in Tennessee for a year and a half, in Florida since last.
But sorry, I bet you've been in Florida working on that property. That's where the mural.
Oh yeah, I was. Yeah, which is performing well now. So that,
yeah, but you
validated.
didn't buy passive income. You
No,
bought
no,
yourself
no.
a job and you went in there, and it's better than working a W-2, but it's not free money that just flows in because you made one decision.
Yeah.
There's a lot of people that thought that's the way it should work, and they're finding out the hard way. It's not like that. Real estate investing is not a way around hard work. It's just a way to get a better return on your hard work where you make money in several ways. So that's the people that are going to come through this tough time, is the ones that they're not letting a property manager deal with their properties and not knowing what's going on. They're paying attention to it. They're watching what they're working on. They're watching where their money's going, and they're watching how their investments are doing. And then when we come out the other side, we'll probably print a bunch more money. Rates will come right back down again. Some new politicians are going to want to look good. We're going to have more inflation, and those that own assets are going to crush it. And those that don't are going to become even more hopeless. So anything you want to add to that?
Well, yeah, I mean, I think that, so when I listen to like Grant's video, all the videos we've listened to tonight, or read any articles, what I think is that I can't control the vast majority of what I'm hearing. I can only control how I react to it. And the best way for me to react to it is to not pursue passive income, because then I feel like I'm chasing deals that everyone else is. Well, there are people that have much more money than me that are chasing too. And so I have to find areas, whether it's real estate or side hustles, where I can put in some work, some sweat equity. But then also, for a big part for our family is playing defense. I mean, we've been doing this for a long time, since before we were in real estate. That was, fortunately for us, we were playing defense for longer than we knew what that was. And when we decided to get into real estate, we were in a good financial position to do that. But even since then, right, I don't have enough passive income or even semi-passive income to sustain if I were to leave my W-2 right now. So for us, for our family, it's all about, crunching the numbers and like paying attention to our budget. And daily. I mean, we're daily looking at, what we're spending on groceries, gas, all the things, because we're trying to be as conservative as we can, especially right now.
Yeah. Dude, I love it. You have a great approach. You have a great personality. You have a great heart. You're one of my favorite people in Spartan League. I'm glad you're coming in. And you're here because I think you're a great example of what I want everyone to follow. You're not trying to hit a home run on every pitch. We all knew that kid in Little League that thought he was going to hit a home run every time. We all knew the kid on the basketball court that wanted to jack up a three as soon as they touched the ball. They weren't working to get a good shot. They weren't playing within the system. They were trying to just make everything easy. There's people like this in every sport, right? There's the quarterback that wants to throw a touchdown on every pass. There's the guy that wants to get a knockout on every swing. It doesn't work. Occasionally it will happen in certain environments. You can be more successful with that than others. But over the long term, you always come across a person that figures you out and you end up losing way too much. It's way better this is going to sound corny, but to be the tortoise than the hare. To take the slow and steady approach, to quit worrying about what you see everybody else doing, to methodically plod ahead, to take advantage. When you hit a home run when the pitcher makes a mistake, you don't hit a home run because you just swung as hard as you could every single time at the wrong pitches. Sometimes the economy throws you a bone. Sometimes you're in the right situation at the right time and you're well capitalized when properties go down, or you buy into real estate and you get a big run like what we had and you do great, but you can't make that your strategy all the time, Jason. And I think you're a very good example of the person who's like, nope, I'm just going to do the best I can with what I have. I'm going to run my properties. I'm going to do well. I'm going to learn. When my next opportunity comes, I will take advantage of it. I'll be more successful than my competition because I learned when they were all trying to find passive income or making money in Bitcoin or buying NFTs or looking for the next big thing where they could hit a home run without a lot of work. So thank you for that.
Yeah, no problem. Just for the record, I was the guy in high school baseball, and my my batting average was 300, and all I did was bunt.
You bunted to 300?
I bunted to 300, and
you must have been fast.
Every once in a while they let me swing the bat, and one time I hit it to the warning track, and I was as surprised as anybody else. And but the thing is that I just was the guy that got on base. And, that's how I play, like, my financial situation now too.
But you know what they say, man, you get on base and good things happen, right?
That's right.
You get on base and then the pitcher makes a mistake and he throws a pass ball and you get to second base. And then the guy who's batting makes a mistake and hits a pop fly to right field, but you get to third base tagging up, right? And then the next guy gets up and he strikes out, but the guy after that gets a hit and you scored because you took advantage of other people's mistakes, right? That is a better way. What's that, Kyle?
The Billy Bean approach, right? Sabermetrics.
Yes.
Just get on base.
Yeah, versus when you try to hit the home run and you hit it to the warning track and you get out, well, then the pitcher throws a pass ball in the next play and you're like, damn it, I could have been on first. I would have got to second if I had just got on base. And so finances are more than just getting that one deal that sealed it for you and you never had to work. That's always what the gurus flash in front of you. If you take my course and buy this one house, it will change your life. You'll never do anything again. But no, you got to be able to manage the money that's coming in. You got to be able to do a very good job at your work or managing the properties, whatever you have. It's that 3 pillars approach that we're talking about. And that's how you survive these crazy times that we're talking about, right? Can you imagine, like, banks really only make money by taking in money from depositors and then buying assets with it. They have a pillar. Can you imagine if banks were able to use the other 2 pillars, if they were able to earn money in different ways than just making investments? And so, like, if the bank also had, some kind of like financial services where they were able to sell people different products, or if they were tied to Amazon, we're like, well, damn, the investments aren't doing very well, but we don't have to go raise money from someone else. We could just sell more of something, or we could do a better job in some other area. Silicon Valley Bank would have been fine. We can all set our lives up to have that diversified risk if we want. I bunted to 300. That if we ever get you on the Bigger Pockets podcast, that needs to be like the title of the show.
That's it, man.
Great.
I mean, for the record, you could bunt down the third baseline. You can push bunt. I mean, I was pretty crafty.
Yeah, you were kind of sure of bunting, right?
Yeah, a little slap bunt every once in a while.
That used to be in softball when I played softball. That was one of my strategies. Like I had the year I played consistently, I batted like 700 or 800, right? It's much easier slow pitch softball, right? But when I would get 2 strikes on me and I was afraid I was gonna like hit a fly ball and get out, I would, or I saw a foul ball, because in softball, if you hit a foul on your third strike, you're out. I just did this thing where I would just hack down on the ball, and like none of the dudes playing third base were fast enough to charge in. And it was like my version of bunting. I could just outrun it every single time. And yeah, I like it. You're like you're the bunting expert. Maybe you could have a YouTube channel all about the art of bunting.
I don't know. It's
lost
a
art.
little bit older,
I saw a video of a baseball player that bunted down the third baseline during a shift, and I think he got a double.
Yeah,
he bunted a double because there was like no one on the left side of the field.
Wow.
Yeah. But you got to take advantage, right? That's what
strategy.
Yeah. All right, thanks, guys.
All right, thank you.
Good man, Jason. See you. Have a good night.
All right,
Kyle, you want to play the last video?
Yeah, I got it all queued up, ready to go. You want to give any kind of
guys, this is one of the reasons that you need to listen to information from a lot of different places, because what you just heard was a video from someone telling us like, hey, this is what the information we're getting from Zillow is. This is what the Bureau of Labor and Statistics is saying as far as jobs. Okay. And if you just go, okay, sounds good to me. Inflation's only 8% because that's what the CPI says. You don't think it's that bad. But if you're not paying attention to the CPI, if you're actually looking at the money that's been printed, inflation is much higher than that. Okay. This interview that you're about to hear is from a guy that I respect a lot in the mortgage industry named Barry Habib, probably the smartest guy that I know in the mortgage industry, talking about how the Fed, the numbers they're reporting to us are not exactly honest. And that shouldn't really shock us if you're thinking about the fact that the presidential power and the people that are in positions of power, whether they're Republican or Democrat, are always going to want to shine things up a little better than they are. So let's take a look.
Job market's so great. You got James Bullard. You got all of them on parade saying we got blowout jobs number. BS. Okay. Number one, in January showed 517,000 job creations. That is not for real. What we had a seasonal adjustment. The numbers showed we lost 2.5 million jobs, but they said, January we usually use 3 million. So poof, 500,000 jobs created. We did not create those. But what's even more egregious, take a look, Rob, just scroll through real quick to the next one. I want to show you. So this is the 517, right? It really would have been 2.5 million losses on the next one. And go ahead and scroll through if you can. And I wanted to show you the thing from the BLS. Just go to the very next slide. Just advance it to the next one.
You see the bottom left? It says the arrow. I don't know if you see there.
Just advance it to the very next slide. There you go. At the bottom there, you see what says 2.5 million losses? That's from the BLS. You can't play with that. Now look at the next one. The next one's absolutely crazy, Pat. Look at these numbers, guys.
That's Bureau of Labor Statistics.
Right.
That's our government, folks.
That's our government. So take a look at what they showed from the household survey, which, as you all know, that's where you
zoom in, Rob?
That's where you get the unemployment rate.
Yeah, there you go.
They claimed in January we created 894,000 jobs. But what they did was they made an adjustment called a population control effect. What was that? They picked up some undocumented workers from early 2022. Now, any of us, logically, wouldn't you just go back and say, oh, let's revise the numbers? No, Pat. You know what they did? Although they were never created in January 2023, they put 810,000 jobs as created in January 2023. That's why the unemployment rate went down instead of going up. Without that,
you're kidding.
No, that's right from the BLS. That's right from the.
So those 810
were created in 2022,
but they put it in
2023. Now I don't want to. This came out February 3rd. Guess what happened 4 days later? By the way, do you know
what's that?
What was the big
510?
No, the State of the Union address was 4 days later. Okay, so now. Who knows if they're related? I'm not going to say they are, and I just think it's kind of coincidental. But now when we take a look at something like this, that was what happened in January. Let's go to February's numbers. February's numbers were, I think, very indicative. If you wouldn't mind, just go right to the next slide, brother. So this shows you what it would have been. It would have been 3.9% without the seasonal adjustment instead of 3.4. Now, in February's numbers, here's what we got. It showed 311. Go to the very next slide if you can. 311,000 jobs created, right? But you see on the bottom in yellow, there was a big jump in this one category that says if you're unemployed for 5 weeks or less, that jumped by 343,000 people. So go to the next slide. This kind of illustrates it. So that's a bucket. That bucket jumped by 343,000. So what goes into the bucket? People that just got unemployed. What drains the bucket? If you either got another job or you're unemployed less than 5 weeks. If the job market is so hot, we know that the jobless claims reportedly that week were only 194,000, near very, very low. So you're not getting the inflow into the bucket, but it's not draining because people either aren't getting jobs or they're being in a position here where they're staying unemployed. That's why you see this going up.
It's so wild that they presented the way they do to say it's the lowest in how many years? Lowest in 57 years, 50 something years. Hey, it's the lowest in this, is lowest in that. So okay. So Barry, if what you're saying is true, and let's just say it is based on the numbers you're giving here, it's BLS. So it's not like you're getting the number from a survey. Then that means the economy is worse than it really is. Is that a fair assessment?
We have less full-time jobs now than we did back in May of 2022. Much of the job gains are part-time workers. Much of the job gains are people working multiple.
We have less full-time workers today than May of 2022.
You can look at
That's not good.
Now, Pat, the next one's going to really blow your mind. Check this out. Now, we got all these job gains, right? Go to the very next slide if you can, please, Rob. This one's really interesting. Do you see that chart on the bottom there?
Yes.
That chart on the bottom shows COVID.
Yeah.
But what these are is hospitality and leisure workers.
Right.
This has been the engine of growth.
Sure.
Most of the job gains have come from this category, but it's not real growth. You're just putting these poor people back to work, right? But if you notice, we're almost back to trend. Do you see that?
We're even lower than that.
But eventually, let's say we put everybody back. There's not that much more juice left to be squeezed here, right? And if you take a look at the job openings and labor turnover, known as the JOLTS report, this is job postings.
Yep.
This category last month was down 194,000. So this tells me the labor market's about to take a negative turn.
If the labor, and I'm with you, I'm fully there, and I've been saying this for a few months, where I think that's the number no one's talking about. Okay, but let's go there. Let's go there. Your background, for people that don't know your background, I mean, if you've been on a couple other times, we had you on a podcast. Your background, for people that don't know this, you have won the Crystal Ball Award for the most accurate real estate forecaster in 2017. This is through Zillow. In 2019 and 2020. You're the only 3-time, I believe, right? Okay. So you've been able to successfully forecast what's going to be happening. That's kind of what you're known for with that part of your success. You've done other things, but this is specific to this.
But we have a great team. It's not just me. Our team,
I'm sure
we have
the
a great
team is very good.
It's a team effort.
It's impossible for you to do it by yourself. You need the right people to give you the data, but still your name is tied to you based on the data you get, These are the forecasts you made. If these numbers are the numbers you're showing, and we just had what's going on right now with Silicon Valley Bank, okay, and Powell is going to be sitting here. A lot of people were saying, well, before Silicon Valley Bank, he was going to raise the rates by 0.5 point and maybe another 0.5 point, and then back to back, quarter to quarter. Now, some people are saying he's not going to do anything, let alone some people are saying he may even cut and lower it. So what is your forecast based on this, based on inflation, based on Silicon Valley Bank? What do you think Powell's going to do next with interest rates?
Okay, so interest rates is very interesting because mortgage rates are going to be more determined by inflation. And the Fed will have more of an impact on shorter term rates and also the stock market. So I believe that the Fed will more than likely have a difficult time hiking more than 0.25%. I think 0.5% off the table. I think maybe 0. I don't think they'll cut at this meeting, but I think that it'll either be a quarter or no move at all, maybe a pause just to see things settle down. Because remember, the Fed, by moving rates up too quickly, has caused these imbalances. Things will break. Now, the problem with the Fed is that they don't look at inflation. Mortgage rates, and real estate for that matter, will be highly motivated and driven by inflation. I have a couple of slides there, Rob, that's probably going to be in the beginning. There's a slide there how mortgage rates follow inflation. If you could see the correlation, okay, this shows you what happens during recession. This shows you mortgage rates go down during every recession. So I believe we're headed for recession. As a matter of fact, while we're on the topic of recession, look at the next slide. Very, very interesting, Rob. Go up one. I'm sorry. Go up one. Yeah. Why haven't we not been in a recession? Maybe we are. We already had 2 quarters of negative GDP, Pat. But take a look at credit card balances. The gray area, that's the recession followed by the pandemic. Everybody forgets we had a recession before the pandemic, 2 months before it. But credit card balances on top were way up, and the savings rate was like 10%. That big spike in savings was the stimulus. That went into people's savings account.
Fake.
But look at what they did with it. They wisely paid off their credit cards. They couldn't spend it on anything else. Notice how they drained their savings and it paid off credit cards. Then we got another stimulus check, but we spent that even faster. But what did we do? We bought a lot of name brand stuff. Then we got, don't worry, got another one coming. Boom. And then once that stopped, people liked that stimulus lifestyle. How do you keep it going, Pat? You charge up your credit cards, which have low balances, and you drain your savings. We've gone from a 10% savings account to 3.5%, and we now owe more on our credit cards than ever in history. Even this has to have a limit sometimes, and that's where we hit the wall.
$940 billion credit card. The reports came in. By the way, savings rate was the lowest we've had since it's a long time. Since 17 years ago, I think it was 2.4% savings rate in February. I want to say these are scary numbers to see that. So again, saying that Powell is almost cornered now with this crisis to have to either not touch it or lower it. Tom, do you think Powell is going to still raise rates? Do you think he's going to delay it 30, 60 days to see how the market's going to react to this, to see if any other banks are going to react to this? What do you think Powell's going to do next?
Well, right now, I think it depends on the next 48 hours. Today was a rough day on the market, but not a cataclysmic day on the market. I'm with Barry. I think 0.5 points off the table now. I think it's 0.25 point. But if there's any jitteriness in the next 48 hours in banking stocks, like there's fallout, they still need to find a buyer for Maine Silicon Valley Bank. Remember, they only found HSBC to buy the UK one, and PNC on Sunday night said, "Nah, I'm out."
So, all right, as you guys can see, not everything that we're being told is always on the up and up. It's very easy to manipulate data and numbers, which is why you just want to be here to listen to this kind of stuff. You want to know what you're being told and who's telling you that. And it doesn't mean that it's doom and gloom. It doesn't mean there's nothing to worry about. We don't draw wild conclusions that are super polarized, but that did change a lot of my perspective on how healthy the economy is underneath the raising rates, underneath what's going on in the banking system, underneath inflation. Just are people working? How much money is being created? How much savings do people have? It probably looks a little worse than what we're being told by a lot of people, which will affect us as real estate investors because those are the tenants that are going to be paying rent. So buying in areas where people have different values, I guess you could say, when it comes to saving money and making money is probably a smarter idea than pushing the luck and getting into some of these bad markets where the prices are cheaper and you think, ooh, the houses are less expensive. That's less risky. Not if the people that are renting from you are the people with the high credit card debt and the low savings that are having a hard time finding work. Kyle, did you have any thoughts when you were listening to that?
Yeah, I think that was very eye-opening for me. I actually hadn't seen that clip before. Usually I have a chance to watch all the clips. That one I didn't see. And yeah, I think that's the most important part, is figuring out where you're getting your information from and how good is that information. How are they getting that information? And in this world that we live in, it can come from a lot of different places with a lot of different agendas. So you kind of have to look at it holistically and why they're actually providing that specific data. So very eye-opening.
Now, if you enjoyed today's show, well, first off, thank you for being here. We know you could get your information from anywhere, so we appreciate that you're here getting it with us. We also appreciate that you spent your Friday night with us, or whatever night it is that you're watching this. Instead of being dumb and out there spending money on things you'll never get back, instead you're saving money and learning how to make more of it. So I love you guys. If you want to get into deeper discussions with Kyle and I about your goals for 2023, you could go to davidgreen24.com/retreats. We're putting together another Scottsdale retreat. It's going to be in like a week coming up very, very soon. If you guys would like, we have a couple spots left open for that one. If you can't make it, that's okay. We're going to be having more in the future, so you can sign up there, but we'd love to see you at this one. We're going to be talking about what your goals are for 2023, how we can help you make goals. That's going to be a much more intimate group where we get to know each other very well. I will be personally involved in helping tweak what your plans are, helping you come up with plans, coming up with a business plan. It's going to focus on setting goals, starting a business, and building a financial fortress, which is saving money. So there's going to be an offensive component, a defensive component, and a goal setting component. We would love to see you guys there. Kyle, tell them what the last event was like.
Yeah, last event was really, really cool. We had about 20 some investors, entrepreneurs, real estate professionals come out and just spend a lot of really quality time. One of the biggest questions I get about the retreat is this just going to be us lounging around a pool all day and not really doing anything? Is this going to be something where David just shows up for 10 minutes and walk away? It is not that. It's the opposite. A lot of our itinerary and our daily schedule is focused specifically towards learning as much as we can, not only from David, but from everybody, from one another, and really putting some action plans together. So it's a really cool group. We end every day like exhausted just because of how much we put into it, time, effort, tears, sometimes sweat. It's just a really, really good opportunity. And I look forward to these things all the time.
Yeah, and it's fun. I mean, last time I think I wore everybody out with how much information I shared. So we're going to try to make it a little more interactive and a little less getting information in lectures. But it's a great way to just change what you're thinking about, walk away with a plan, knowing what you want to do. So we'd love to see you guys there. And then if you want more discussions like this one, if you want more access to me, if you want to ask specific questions, if you want to learn from guys like Jason, who is in here, Spartan League, you're only hearing about it on YouTube right now. I have the website up. You can go to SpartanLeague.com, but I haven't started talking about it all the time. That's going to change. We've been waiting to get all the swag together. Once we have it, you're going to see sponsored ads going out on social media. You're going to see me talking about it a whole lot more. We're going to be starting different groups. I want people to understand that right now is the time to play defense, and you need to get around other Spartan warriors that understand defense. Are going to encourage you to do that. The other thing that I would say is during COVID, a lot of people were like, couldn't go anywhere. You couldn't do anything. The people that got into fitness changed their life, and the people that got out of fitness had their life changed in a way that they didn't like. Okay. This is something else to think about when you're playing more defense. Push yourself with nutrition, push yourself with working out, take advantage of when, hey, there's not much money to be made. There's not many deals to be had. We have to wait this out. Well, don't sit around and do nothing. Make gains in other parts of your life, because when the money's rolling in, I'm just going to be honest with you guys, it's very hard to make time to go work out when you know you can be making really good money doing something else. You got to make hay when the sun shines. So when there's opportunity to make it, you make it. And when there's no sun shining, well, heck, get in the gym. We're going to be putting together in the group, we're going to have a fitness app that we eventually develop where we're going to be tracking that. And it's a really cool thing when you see your body start to develop and change and you feel that progress coming. So we'd love to see you guys in Spartan League. Oh, look, we got Mikey here, or Mickey. He was at the first retreat we ever did, and he was a blast. This guy's a pool shark. by the way.
He's very, very good.
Kicks everybody's butt. We have a very cool pool table as well as a pool to swim in if you so desire, and probably the biggest TV that I've ever seen. Very cool property. You guys don't want to miss that. So check out SpartanLeague.com and check out davidgreen24.com/retreats. And make sure you subscribe to this channel. If you like the video, please make sure that you like it. And we will be back here next Friday with another YouTube Live.
Awesome. And one last thing I want to say is we're getting a lot of questions is, hey, when can we get the swag? Is it going to be available? It is going to be available soon, and there might even be a little marketplace where you can buy it. So keep an eye out for that kind of stuff too. But on behalf of David and myself, we will see you guys next Friday, hopefully live from Scottsdale. Should be fun. See you guys.